Good morning.
Hey, John, welcome back. You see the
Uh,
slides?
yes, I can see the slides. Thank you.
Okay, we'll give Joshua a moment to join us as well. I guess this is the last chapter we do before the test. And I don't know how early you got in here, but I was talking a little bit earlier. Looks like we have time for a good review on Friday, maybe, no?
Oh, great. Okay.
Yeah, the test is, I think, the 23rd. So
Yeah, that
that
would be
means,
Saturday, I guess. Yeah.
yeah. I had a good review yesterday with a couple of students in the tutoring. They just wanted to ask a couple of questions, and then it developed into a full-blown presentation that I think worked out. I didn't record it. I never record the tutoring stuff. So we'll give Josh another minute here. I don't know if he got delayed.
I think he just popped up. I see him.
Oh, okay.
I'm here, boss.
All right, there we go. Gentlemen, welcome to chapter 9, fixed assets, long-term assets. Like we were saying a little bit earlier when we last met, fixed assets are the big ticket items. Explain the accounting. What are plant assets? Plant assets are also called fixed assets. I like fixed assets as the term. Plant assets is okay as well. But we're talking about big ticket items that have a lot of cost to them. Machinery, vehicles, computers that are going to be around for a number of years, hopefully providing benefits to us. And we have to properly record them, depreciate them, and perhaps someday dispose of them. So let's see what we're talking about. Here's where we're talking about Wendy's here. Wendy's hamburgers, 73% of their assets are in fixed assets. And I guess that makes sense after thinking about it, because when you walk into any Wendy's, what do you see there? You see a bunch of cooking machines, in the back. They've got refrigerators. They got microwaves, probably. They've got ovens and stoves. So I could see that a lot of their fixed assets are a big percentage of their total assets. Microsoft, as you would expect, you see only 3%. They're not buying gigantic equipment. Everything on our balance sheet is at historical cost. We've been over that a bunch of times. It means that once you put it up there at the historical cost, what you paid for it, you will never change that historical cost to write it up for a gain. You only have to recognize losses. And that's the conservatism principle in GAAP. And we have cash equivalent prices, the fair value of the asset given up, the fair value of the asset received. That will go into a little more detail later. Revenue expenditures, costs incurred to acquire a plant asset that are expensed immediately. There are certain things that are expensed that have nothing to do maybe with bringing in the fixed asset. A silly example, when we were renovating that new factory in Baldwin Park, my staff got in the habit of bringing in like donuts every day for the guys working out there. And I was told by corporate office to be very aggressive in capitalizing. And I capitalized the donuts. But the auditor, when he came in, the outside auditor didn't like that. He beat me up over that. That would be an example of an expense, not properly capitalized. I thought I could get away with it, but I got nailed. Cost of the land include all necessary costs included making the land ready. You're going to buy land. You're going to have to pay these various fees, these various costs. So Hayes Company bought land, cash price $100,000. Property has an old warehouse that is raised at a net cost of $6,000. They had $7,500 in cost, but it looks like a junkyard came in and hauled out some of the material for $1,500. And they had the attorney's fees and the real estate broker's commission. All of those things become part of the cost of the land. So that land is $115,000, and it will remain $115,000 as long as it's not impaired. As long as the value does not decrease, it will always be $115,000 until you sell it at a gain or a loss. Cost of land improvements. This is a big thing, huh? Driveways, parking lots, fences, landscaping. Whatever you're going to do, you could put a koi pond in your lawn if you want your place of business. Those are all land improvements, and they get capitalized just like plant assets. Cost of buildings. Again, you buy a building, you have a lot of ancillary costs. You got the purchase price, you got the closings, the attorney, all this, the title insurance. There's probably a lot of others. You might have to remodel or replace the floors or something to get this machine building going. And the construction costs to be the contract price, plus you got to pay for the architect. So you can see there's a lot more when you buy a building than you think. And the same thing with equipment. What's equipment? Let's define equipment as a big computer, something like that, computers, a network. You pay the sales tax, the freight and all that. All of that gets added to the cost of the equipment. Leonard Company purchases a delivery truck at a cash price of $22,000. Related expenditures or sales taxes, $1,320. And lettering, they wanted to put their lettering on the truck. Sylvia's Cleaning, like I see those cars around here all the time. $22,000 plus the $1,320 and the $500. Notice they also bought a 3-year insurance policy. Well, that is clearly not part of the cost of bringing the truck in. That is a prepaid asset that's going to provide insurance for you in the future. So here's how they put this down in terms of a journal entry. Equipment, license expense, prepaid insurance. Okay, the $80, the motor vehicle license, that's an expense. If I said that was part of capitalizing, that's not quite right. So the equipment itself cost us $23,820, plus we have the license expense, the annual fee, and the prepaid insurance. Okay. Expenditures during the useful life. Make sure we understand the difference between an ordinary repair of a fixed asset as opposed to an addition and improvement. Ordinary repairs, normal maintenance to keep the fixed asset running at maximum efficiency. Expenditures to maintain the operating efficiency and productive life. These kind of costs get debited to repairs expense, maintenance and repairs expense. What are we talking about? We're talking about if you have a car, you change the oil once every 3,000 miles, maybe. You change the oil, you check the hoses, that type of thing. You're in a building and you have to put filters into the HVAC system above you, the heating and air conditioning. That's just normal maintenance. It does not improve the efficiency of the fixed asset. It just maintains it at where it's supposed to be. But you could have costs that do improve the asset. If you spend big money to speed up the asset, it's doing twice as much work now. That could be an addition and improvement, which would go on the balance sheet. Ordinary repairs goes on the income statement. Additions and improvements or capital spending balance sheets. Then there's always the question about whether you should buy or lease, and there's advantages to each. What is a lease? It's just a rental agreement in which the owner of an asset, the lessor, allows another party, the lessee, to use the asset for a period of time at an agreed price. And they love to put the word lessor or lessee on the test. They'll put that in the form of a true-false question. True or false, the owner of the asset is the lessor. You say true. And one advantage of leasing, you don't worry about obsolescence because the lease is for a finite amount of time and you can start over again. And normally there's no down payment. And then you have tax advantages because the payments are tax deductible. So Drummond purchases a delivery truck and includes these various costs. And let's take a peek at them. What goes on the balance sheet in form of the cost of the truck? Well, the machine itself was $15,000, this truck. Sales taxes were $9,000. Yeah, makes sense. Delivery, and they put their company logo on it. The $600 for the insurance policy and the $80 For the license, the annual registration of the car itself are operating expenses. Apply depreciation methods to plant assets. Okay, depreciation, we're going to get into that a little more than we have so far. It's an allocation process. You are expensing, if you will, the cost of the fixed asset over its useful life in a rational and systematic manner. That's a gap term. What you do in these types of things must be considered rational and systematic. There's some leeway in putting the numbers together, but you can't go crazy and affect one year much more than another year with a few tricks. It applies to land improvements, buildings, and equipment, not land. So keep that true or false question in your head. You do not depreciate land. You do not depreciate land. Depreciation is allocated, and the item is depreciable because the revenue ability of the asset will decline. So we should know this journal entry. Remember this from our adjusting journal entries? Depreciation expense. We debit depreciation expense, and we credit the contra asset account called accumulated depreciation. It's a contra in that it has a normal credit balance as opposed to a normal debit balance for an asset. And like all contra accounts, it's married to somebody. And in this case, the accumulated depreciation is married to the cost of the fixed asset. Factors in computing. Well, first of all, we want to make sure we get all the costs involved. You just saw that buying a truck is not just a matter of writing a check for $100,000 and you have a truck. You got to put the property taxes in there, the stenciling you might want done on the truck, and some other things. So first of all, we want to make sure we come up with the correct cost. Then we have to estimate something called a useful life, accounting's useful life. It's an estimate of the expected life based on need for repair, service life, and vulnerability to obsolescence. That's just a long-winded way of saying how many years do we decide we're going to depreciate this asset. This is a truck. We think this truck will last us, say, 10 years. That would be the useful life. You can't say, well, this truck is only going to last us 1 year, knowing it's going to last 10. And by doing that, you take a gigantic tax deduction in that particular year. You can't do that. And then we have to consider the salvage value. What is this machine going to be worth after 10 years? We have to estimate that now. And the key thing to understand with salvage value is you do not depreciate the salvage value, nor can the net book value of the asset ever go below the salvage value. And we'll be practicing that. So it looks like they're going to take us through three methods of depreciation. Straight line, which we know, declining balance, and units of activity. You see where it says declining balance, guys? Add, excuse me, add the word double in front of declining. It's really should be called double declining balance because it's 99% of the time double whatever the straight line rate would have been. In other words, if you have an asset and you are depreciating it over 5 years, that's 1/5 a year. Declining, double declining balance says multiply 1/5 by 2, and now you're depreciating at 2/5. Units of activity, we'll get to that in a moment. That could be miles, for example. Bill's Pizzas. What is with the pizza in all these classes? The other book is all pizza. Mitchell. Bill's Pizzas purchased a delivery truck at the beginning of 2022, and $13,000 was the cost, and it has a salvage value of $1,000 and 5 years life. They expect this truck to go 100,000 miles in 5 years. So armed with that information, let's calculate the depreciation using our three methods. First of all, straight line. Straight line, we don't depreciate the salvage value. So our depreciable cost is going to be $12,000, and it's 5 years. it's going to be 2,400 a year. So this is pretty simple. We paid 13,000 for this asset, this pizza truck. The salvage value, we think somebody will come in and give us $1,000 for it in 5 years. That makes the depreciable cost 12,000. 12,000 divided by 5, $2,400. So I don't think we have trouble with that calculation. I'm assuming, based on what I saw on the test. Anyway, we debit depreciation expense for 2,400, and we credit accumulated depreciation for 2,400. And see how nice and linear it is. We started off with a net book value of $12,000, and we're reducing it by 1/5 every year. So it goes down 2,400, goes down 2,400 until you hit the salvage value. You can never go below salvage value. And they'll ask about that on the test. Our accumulated depreciation goes up evenly and incrementally by $2,400 until the accumulated depreciation of $12,000 gets subtracted from the 13,000 value, and we end up with the 1,000. Okay, so straight line, I think we're good. Let's see what else they have for us here. Here, the only thing they're showing us, guys, is something I think we know. They're just saying, suppose we bought the truck in the middle of the year. Well, it just means that we have to prorate the year into 9 months. For example, they bought the truck on April 1st, so that's 9 months of the year that we depreciate. Straight line again. Iron Mountain bought a snow grooming machine for $50,000, 10-year life, 2,000 salvage. So we know we're only going to depreciate the 48,000. You never depreciate the salvage value. 48,000 divided by 10 is 4,800, and there's your journal entry, which is always, without exception, a debit to depreciation expense and a credit to the related accumulated depreciation. Here's the double declining balance method. This is an accelerated method. It's more aggressive. With this method, companies have an opportunity to put a lot more depreciation expense in the early years of the asset, as opposed to smoothing things out over the years, as does straight line. Declining balance, decreasing annual depreciation expense over the useful life. It's double the straight time rate. Can we remember that? It's double the straight time rate. If it's going to be triple depreciation, it would be very unusual, and they would tell you that. But we know it's double declining, double the rate of the straight line. Now, here's a little tricky stuff with declining balance. Here you do depreciate the salvage value, okay? This is the only method where you do depreciate the salvage value. So remember, we bought the machine for 13,000. Unlike up here, where the depreciable cost was 12, here the depreciable cost is 13,000. It was 150 a year. It was 20% a year, right? Straight line. 20 times 2 is 40%. So once we know the rate, we're going to take 13,000 times 0.4. That's $5,200. That's going to be our debit to annual expense. That's going to be our debit to depreciation expense and our credit to accumulated depreciation. That reduces the book value to 7,800 after the first year. Second year, we take the new book value and we multiply it by 40%, and we repeat the process. So you go 7,800 times 0.4 is 3,120. Notice what happens here. 5,200 the first year, 3,120. So you can see it starts real heavy in the first 2 years and then comes down gradually. And they're making a note here that's kind of important. Since we can never have a book value that goes below the salvage value. When they did 1685 by 0.4, they came up with a number that had to be adjusted to 685. So we matched the salvage value. So double declining balance, you do a little homework. I don't think it should be too bad for you. And here's another example here. Looks like this is, oh yeah, they're just showing you that again, they bought the machine on April 1st. So it's only 9 months in the first year and 3 months in the last year. Unit of activity. Units of activity. This is based on miles or the number of strikes that a machine may make, the number of bottles that Coca-Cola stamps out. You bought a truck, say, for $12,000, and you think that truck is going to go for 100,000 miles. Okay, guys? That's 12 cents a mile. That's our estimate, 12 cents a mile. All we do is take that 12 cents a mile and multiply it by the actual miles driven. That's all. So this truck was driven 15,000 miles, 30, 20, 25, and 10 times 0.12. Here is our debit to depreciation expense. And here is our credit to accumulated depreciation, okay? So on this method here, again, you are removing the salvage value. We're working with 12,000. The only one where you do depreciate the salvage value is double declining balance. So you go, management's choice. They have a $12,000 asset, and they're showing you the different annual expenses. Annual depreciation expense varies, but the total at the end of 5 years has to be the same, right? So the company that went declining balance, that's 5,200. Let's compare that to 2,400. The difference is 2,800. Well, this is a big company. That's really $28 million. We multiply 28 million by a tax rate of about 3%. That's $8,400,000 this company saved in taxes by having that. But in future years, they don't get the same break. And the most popular one is a straight line, by the way. And they're just showing you the annual cost for each one. IRS does not require taxpayers to use the same depreciation method on the tax return. IRS requires either straight line or the modified, not acceptable under GAAP. We can ignore this slide here. We don't get involved in that. You'll find notes in the financial statements, huh? Southwest Airlines. Depreciation is provided by the straight line method to estimated residual values, that's their salvage value, over periods ranging from 23 years to 25 years for flight equipment. Revising periodic. Now, what can happen is a machine can slow down. It's no longer working at the same efficiency and never will. Or we can improve the machine. And I don't mean by good maintenance, that's part of it. I'm talking about spending a lot more money to upgrade the machine. So let's see what we have here. And this is fairly normal stuff. Arcadia purchased equipment for 510, useful life 10, salvage of 10. Depreciation's been on straight line. So we know they're depreciating 500,000 a year for 10 years. In year 8, 2022, it determined that the total estimated life should be 15 years. With the new salvage value of 5,000. How do we handle this? Well, let's divide and conquer. What we need to do is twofold. One, we got to come up with what the net book value is up to the point of the start of the 8th year. And then we'll layer on the new items. So let's take a look. This can be a little tricky until you do a few of them. But let's see here. We have a machine that after 7 years is going to be changed in terms of the life, okay? So we had original cost of 510, salvage value at 10, the depreciable base is $500,000. Divide that by 10, 50,000 a year for 7 years, 350. That's simple enough, I think. The equipment cost us 510, depreciable value, minus 350 gives us 160,000 book value. Now, the problem said we would be depreciating not for 7 years, but for how much was originally 10 years. So we've added 5 years more to the life of this machine. So take a look over here. We have net book value of 160, which we just calculated. We're going to take the new salvage value of 5,000, and the machine now has 8 years left of depreciable life. So we debit depreciation expense, we credit accumulated depreciation. Hey, Joshua, did you follow that?
Yeah, and I do have a question. That's to say, like, say we add like an upgrade to the machine, right?
Absolutely, absolutely. Okay. Yeah, and we'll get to an upgrade. That's a great question. Yeah, we'll do an upgrade probably in a slide or two. This is just increasing the years the machine's going to last. That's all.
Okay, that's just like basically you reevaluate, like, oh, you know what, we can probably get a few more years out of this.
Yeah,
and then
exactly.
That's how this calculation happens.
Yeah, this machine we thought was only going to last us, what did they say, 10 years or
10.
whatever, and now it's gone up to now we're looking at the machine and the thing is going great. Our engineer said this thing's going to last us for 15 years, so we need to show the impact of that.
Perfect. Thank you.
Impairment. Now here is something else. An impairment of a fixed asset simply means that the value of it has gone down. If you paid $100,000 for a machine that makes VCRs, that machine is probably not very busy and thus isn't worth very much. You would have to write down a loss on that machine. Now here's what Joshua, I think, was just getting at. Revised depreciation. They purchased, this company bought a machine for 36,000, 6-year life, 6,000 salvage, straight line. Let's put all those facts in our head, huh? So 36,000, we have to subtract the salvage because it's straight line and divide by 6. So I guess that's 5,000 a year. At the end of year 3, before the depreciation adjustment, it estimated a new total life to be 10 years and new salvage value to be 2. And I guess this is the same exact thing we just did, right? The equipment cost is 36 minus the salvage value. And the machine has been going for 6 years and the annual depreciation is what, 5,000 per year, and they're doing this after 2 years. After 2 years, and the new salvage value is $2,000, and it's going to be depreciated for the remaining 8 years. So that's pretty much the same exact problem we just saw earlier.
I have a question. So it said in the word problem, it said at the end of year 3, but here they're only calculating the depreciation for 2 years.
Yes, and they made a pretty clear note on that, which I compliment Wally. At the end of 3 years, at the end of year 3, before the depreciation adjustment. So okay, that's telling you that, yeah, they did it at the end of year 3, but they only did the first 2 years, only recorded 2 years of depreciation. So they're going at the beginning of year 3 to start catching up.
Okay, thank you.
Yeah. That's a good question for a couple of reasons. Because without that note, before the depreciation adjustment, how would you know if they did it at the end of the 3rd year or not? You really wouldn't. Instinctively, I would think they would have done 3 years, which is where I think you were going with that. And revised depreciation. Disposal of plant assets. I'm going to give you a journal entry to make this super easy for you, okay? Accounting for disposal of fixed assets, not too tough. What we have to do is eliminate from our balance sheet the net book value. That means we have to zero out with a credit the original cost of the equipment and zero out the accompanying accumulated depreciation with a debit. That removes the net book value. We compare that to the cash we got, and we either have a gain or a loss. Equipment, so we're talking about equipment sold to another party, or we retire it, or we're exchanging it for another asset of some kind. Compare the book value with the proceeds. If the proceeds exceed the book value, you have a gain, less you don't. Here's just a depreciation entry. I don't know where that came from. So let's take a look here. You have an asset, office furniture, and so far you've depreciated $49,000, bringing the net book value down to 11. You sold it for 16. Hey, you have a gain on the asset. Simple as that. Well, let's make it easier, I think. If I were you guys, anyone in the class, I would write this journal entry down. I would write this journal entry down on a piece of paper and refer to it when you're doing these problems, because the journal entry is always the same 4 items. It's going to be a debit to cash, a debit to accumulated depreciation, and a credit to the original cost of the equipment. And then you just balance out to a gain or a loss. In other words, the way I like to teach it, we got cash, 16. We got rid of the accumulated depreciation, that's 49. And we had equipment of $60,000. Well, we're short here. Our credits are less than the debit, so we add a $5,000 credit, and that is a gain on a disposal of a fixed asset. You might get homework questions where they don't sell it for cash. They got an airplane or something, or another piece of equipment or something. The consideration doesn't have to be cash, is all I'm saying. But the journal entry is always the same. It's a debit, and I'm going to say a debit to cash, debit to accumulated depreciation, credit to the original cost of the equipment, and a credit to the gain on disposal. If it was a loss, you would see that 5,000 on the debit side. Here, they're showing you one with a loss. One with a loss. They sold the asset for 9,000. Here's our 49,000 in accumulated depreciation. The original cost is 60. So this results in a $2,000 loss, because when we add up the 2 debits, it comes to 58,000. So we have a loss of 2,000. And a retirement of a plant asset, well, that's the same thing, except you're not getting anything for it. You're going to, I want to go back up here. They're not giving us a calculation, but very simply, retirement of plant asset. This machine we want to take off our books. We don't ever want to see this thing again. You debit accumulated depreciation, you credit the original cost, and that would be the book value, and that becomes your loss. Retirement of a plant asset is always going to end up in a loss, right? You didn't get anything for it. Plant asset disposal. So they're showing you 2 scenarios. One, they sold the truck. They sold this truck for 17. They got 17. Original cost was 30. Accumulated depreciation 16. We have a gain. And in our second scenario, the truck is worthless. So we're retiring it. You're going to see that same entry without the words cash. And here it is. 16,000 was the accumulated depreciation. 30,000 was the equipment we're reducing. Net book value is 14. That is a loss on that asset. Let's have a little fun with intangible assets. Intangible assets. You can't see them, you can't touch them, you can't feel them, but they're there. We know they're there all the time. Intangible assets, privileges, competitive advantages. What we're talking about is really intellectual properties, patents, copyrights, franchises or licenses, trademarks, trade names, and goodwill. Patents are the ones we concentrate on in teaching this. A patent has a life of 20 years, and it's the reward you get for developing a product yourself. You spent 20 years working on some magnificent invention, and you came up with it. And now you go to the United States Patent Office, and the United States government issues you a patent. That patent means that you own all of the rights to that product. Only you can produce it. Only you can sell it, make a profit from it. And it's up to you what you want to do. Many inventors, when they get a patent, the first thing they do is sell it to somebody, because the inventor may not be in a position to mass produce his product. You know, if you're lucky enough to invent a machine that stamps out bottles more quickly than Coke is doing, well, chances are you're going to say to Coke, how about you buy this thing from me? I think $20 million sounds good, and a penny a bottle for the rest of our lives, okay? Copyrights, that's printed material. Trademarks, that's your McDonald's logo. Trade names, goodwill. Intangibles have a limited life, and we amortize them. We don't depreciate them, we amortize them. And we credit the asset account or accumulated amortization. I'm going to raise my hand and say, the way I'm teaching it, you always credit the asset account. I've not seen companies use accumulated amortization, just in my little bit of experience with intangibles. And the other textbooks teach it that you always decrease the original cost, unlike a fixed asset. So you have limited life intangibles and indefinite life. If it has an indefinite life, you have no idea how long this thing is going to work, be good for you. You can't amortize. You just can't do anything. Cost of patent, the exclusive right to manufacture, sell, or otherwise control an invention for 20 years. Capitalizing the cost of purchasing a patent. Now, you might find this interesting. I invented a product, okay? I own the patent, but I can't amortize it. I can't amortize it because I already got the benefit of building my product. The only people who can amortize a patent would be the party to whom you're selling it. So I sell this patent to John here. I sell him my patent for $1 million. He will then, starting on day one, amortize that over the remaining life of the asset. Maybe 20 years, maybe I sold it to him after 1 year, then it would be 19 years. R&D costs are always expense, research and development. That's why when the inventor gets the patent, he's not going to be amortizing anything. It just gives him the right to control it. So typically, inventors will be selling their patents to people. Legal fees incurred are capitalized on a patent. So let's see what we have here. National Labs purchased a patent. Notice they purchased it. $60,000 on June 30th. 8 years is the remaining life of this patent. Or 8 years is how long they think the patent's going to have value. You prepare the journal entry as follows. You paid $60,000. You're going to divide it by 8. That's $7,500 a year. Since you did it in the middle of the year, you debit amortization expense and you credit patents, just like I told you. You credit the original cost account. So that's not so bad. 60,000 divided by 8 is 7,500. It would be this journal entry, 7,500 a year for the rest of the life of the patent, after you have a partial first and last year. R&D, all costs involved in developing a patent or a copyright or new processes, new intellectual property are expensed when incurred, okay? Copyright. It gives the owner exclusive right to reproduce and sell an artistic or published work. It's good for the life of the creator plus 70 years, huh? The life of the creator plus 70 years. Pretty soon, when did Hemingway die? 1964. So in the year 2034, not too far off, we can go out and we can, prepare one of his novels. We could do The Old Man and the Sea or something at no patent infringement or copyright infringement. Trademark, the Wheaties label, Monopoly, Kleenex, Coca-Cola, Big Mac. These are all trademarks. Jeep. I don't think you're allowed to call a car a Jeep unless you actually are the Jeep manufacturer, and I'm not sure who that is. And this is 20 years. You don't have to memorize these renewal periods. That's not going to be asked on the exam. They'll give that to you. Franchises, Toyota, Shell, Subway, Marriott. There's a little bit of a mistake here. Unless things have changed, Subway, believe it or not, is not a franchise operation. I never realized that. It has all the hallmarks of a franchise, but I don't believe it is. I've read that a number of times. Like McDonald's is a franchise. The Subway owns each of those stores, and they run those places directly from corporate. Franchises. Goodwill. Oh, goodwill. Goodwill is the amount of money that you pay above the fair market value of a company. I own a company, and my company is worth $500,000 on paper on the balance sheet. The net worth is $500,000. I have assets of $2 million, and I have liabilities of $1 million. I have $500,000. You want to buy my company? I say to you, I don't want 500,000. I want a lot more than that. Well, you're going to give me an offer that I hopefully will accept. And then you're going to look at each of my assets, and now you can write them up. Now you can write them up because you just bought them. So if you think my company is really worth $1 million and you pay $1.2 million, that 200,000 is goodwill. Goodwill, the amount of money you pay above what the company is really worth in your opinion. Why would you pay more? Well, you're anxious to get your hands on my company. You've been watching the Bob Smagula company for years. You say, Bob's an idiot. He's not getting much good out of that company. They have great contacts. They have great people. They should be doing better. I take it over. We can do that. And know these terms. These are pretty basic, I think. Classifications. And here, we're just going to get into the balance sheet a little bit. Remember, we're now working with the multiple step financial statements. Current assets. Look what you have after this. You have a whole section, property, plant, equipment, or fixed assets. They have land, buildings with the accompanying depreciation, equipment with the accompanying accumulated depreciation, and then you bring it down, net property, plant, and equipment, 11,270. And they had 3 intellectual properties. They had patents, trademarks, and goodwill. So that's how it's laid out in your financial statements. And typically you're going to see a note here, a note here, a note here, explaining how they're doing things. This may or may not be on the test. If we were in the classroom, I would warn you right now that this would be on the test. I'm just not sure. But you need to know it. The return on assets, all it is net income divided by total assets. Net income divided by total assets. Net income divided by, let's throw the word average in there. I forgot that word, huh? Net income divided by average total assets. So 1147 divided by the average of 9781, 9323 equals 12%. 12%. The year before, JetBlue was 8.4, and Southwestern has 14.4. And this is an indication of the amount of net income generated by each dollar of assets. It's another metric that investors look at. The company certainly looks at it internally. That's an important measurement. Asset turnover. Net sales divided by total assets. Asset turnover. Net sales divided by average total assets. Okay. This time we're changing net income to net sales over total assets. And it's going to give us an indication what type of sales we're generating. Okay. Profit margin. Well, we've been over this a bunch of times. Net income. Let the garbage guy go by. Hey there. Profit margin times asset turnover gives you the ROA or the ROI, the return on assets, return on investment. Net income divided by sales times net sales divided by total assets gives you the ROI. Net income divided by net sales. That's the one we did over here. Or no, we didn't do it. Net income, net sales times the net sales over total assets. I don't think this is going to be on the test, really. This is more of a 240 type problem where you're dealing with a lot of projects. Profit margin revisited. Just remember, profit margin times the asset turnover gives you the return on assets. So Southwest, it says, was more efficient at generating sales from its asset, while JetBlue was better at deriving profit from its sales. So for every dollar of sale, in other words, for every dollar of sales, JetBlue keeps 16 cents, and Southwest Airlines a little bit less than that with 15 cents, say. But Southwest Airlines turns their assets over more frequently. As a result, they have a better ROI. Asset turnover. We should know how to do it after we practice a little bit. Compute periodic depreciation. Let's see what we got here. And hey, that takes us to the end of our chapter, gentlemen. Oh, just you two guys, huh? Nobody else. Well, you know, while the slides are up, I can't see who's here. So I was saying to myself, I bet I have 20 people sitting here today. No way.
Oh yeah, they all just left right now.
Oh, okay.
There was definitely 22 at least.
Yeah, well, as soon as I saw that last slide, they were out of here. Thank you, Josh. I feel better. Yeah, any questions, comments, Joshua?
No, this was pretty straightforward. I'm like I mentioned last time. Once I got over the terms, I'm not the best at English and terms and vocabulary, but once I've been putting it into practice and the numbers make sense to me a lot more than words.
Excellent.
Yeah.
It sounds like you're doing okay with this. And I was talking with John a little bit earlier. Friday, you got a test, I believe, on the 23rd, which is what, Saturday? I think.
Yes.
So Friday, if you guys want to join me again, we can have a real good review session.
Oh yeah, most definitely.
That would help. Okay.
Yeah, I didn't do that great on the first midterm because again, it was more term based. I felt.
Yeah.
And I didn't perform as well. So definitely, I'm gonna try to do a lot better on these next tests.
Yeah, I'm gonna see if I can get a look at the test beforehand. Not that I'm gonna teach toward the test, but I just want to see what is going to be on there, and that kind of helps me a little bit. John, you're okay with all this?
Yeah, it makes sense. I think I've got the graphs now about where you change the depreciation useful life and kind of how you do it, and I noticed on the homework problem, they did that little trick of depreciating before depreciation was calculated, where they do year 3. And so I'll be
Yeah.
watching just to make sure they don't do that to us.
Yeah, yeah, yeah. That they really do have to tell you that. They have to either tell you verbally like that, or say on December 31st. Then you know it's for just the first 2 years. You know, so
Yeah.
okay. All right. Any other questions? Anybody?
Nope. Thank you for your time.
Hey, good chatting with you, John. Joshua, we'll see you on Friday. Okay, guys.
See you on Friday. Also,
All right.
sorry I didn't make it on Monday. I was really busy, and yeah.
You didn't. You missed absolutely nothing, Josh.
Oh, there was nothing going on? Oh, okay. Perfect.
No, we had. I was gonna have a review, and then when nobody showed up, we decided we'll do the reviews Friday and catch this last chapter now. So you're good, Josh.
Perfect.
Hey, bye, guys.
All right. Have a great day. Stay safe, John. You too.